Okay. Right. Good morning. Till others join the meeting, we'll brief very in a nutshell what we discussed last week. Actually, I wanted you to have a basic understanding of financial accounting before you analyze the financial statement of a particular entity, right? In order to analyze the financial statement, you should have a basic understanding about the accounting techniques that we are using to analyze the financial statements. Then having said that, I started explaining last week the basic concept like the double entry system. Then under double entry system, the concepts of asset, liabilities, equity, income, expenses. Likewise, we did get some understanding about those concepts, and we managed to complete that. Finally, I hope that you have a good understanding how a transaction will get counted in the books of accounts of the entity, right? Now, you know for sure what is the characteristic of an asset, characteristic of a liability. In the same way, equity, expenses, and income, right? How a transaction will get accounted in the books of accounts of an entity with reasons. I told you the one thing you can by heart under accounting is only the double entry system. Other than the double entry system, there should be valid reason for you to recognize, for you to record any transaction under double entry system. There should be a valid reason, right? If you take a simple transaction, what we discussed last week, I said when a depositor deposits some money to a bank, say 10,000, then you from the beginning of your banking career, you used to debit the teller GL account and credit the customer savings account or whatever current account, right? Then I asked the reasons why you debit the teller GL account and credit the customer account. Then initially you might not have any answers for the question I raised, but now you know for sure why you debit the teller GL account and why you credit the customer account. The reason being the teller GL, if you take it from the bank's point of view, it's a cash. Cash is an asset. When asset is increased, you have to debit that particular account. Then the if you take the second transaction, second entry, why we credit the customer account? Not because we are only left with the credit entry. We have finished with the debit entry. We are only left with the credit entry. That's why we credit the customer deposit account. That is not the reason. Customer deposit account from the bank's point of view, it's a liability. When a customer deposit money to a bank, then the liability of that bank towards that customer will get increased. When liability increase, go to the double entry system, it should be a credit entry. Therefore, every debit, every credit, there should be a valid reason. If you summarize the same again, why we debit the teller GL, the reason being the teller GL or the cash. Cash is an asset increase, but that's why we debit that account. Then the second entry, that is a customer deposit account, why we credit that. Customer deposit account is a liability. When customer deposit money, our liability will get increased. Therefore, we have to credit that account. Always, now when you are looking at transaction, looking at from the side of the bank, right? When you are looking at transaction from the side of the business entities, right, you have to wear that spectacles. You have to see the transaction from that angle, right? Otherwise, it will get very cumbersome and very complex. Uh, you are not in a position to recognize the correct transactions, right? Now, when you are doing this particular course, always try to look at transaction from the customer side or the business entity side, because we are not evaluating the credit proposal of banks, right? We are evaluating the credit proposals of customers. Therefore, 99% of the transaction, 99% of the item you have to look at from the customer side, how it will get accounted in their books of accounts, not from the bank side, right? Now, a considerable people have joined, then we can start today's session. Last week we started the second presentation also, financial statement analysis. There we said lending creates an exposure which is associated with risk of present and future income and losses of capital of profits. Definitely, when you are lending, it creates risk to the bank. Therefore, not only today, but also future as well, because normally if you take a lending transaction, it will take some time to set off everything. Therefore, risk assessment and management are very key skills of any successful lending, right? How you assess the risk and how you manage risk is a very key thing under risk lending. If someone want to ask a question, please unmute your mic and ask a question. If you don't want to ask the question, please mute your mics, right? Otherwise, all the stories in your houses will get to know by this entire crowd. Okay. Then we further said lenders involved with the review and sanctioning process of credit have a primary objective of assessing the risk involved with view to minimize loss, right? Again, this point also emphasizing the assessment and review process of risk. Then what we can do is using the credit analysis, using accounting techniques, assess the credit worthiness of clients is very important, because it will be the final decision making source document for any lending decision, right? Whatever you do with accounting, whatever the things you do with this accounting technique, credit analysis technique, will finally end up with some results, and based on which the final decision maker will take the decision. Right? Therefore, under credit analysis, this particular section will play a huge role, because the maximum effort you put on this area will finally yield good results, right? Because the final decision maker cannot do these things. Therefore, as credit officers, as managers, as relationship managers, your responsibility is to do a proper analysis. There can be systems also. You can involve those systems also. But finally, you have to do a proper analysis and interpret it, and put forward to the decision maker to take the final decision. right? Then we started saying there are different individuals and business clients for which you have to do different credit analysis. You take by name, there are individuals, sole proprietorships, partnerships governed under 1890 partnership ordinance. Then companies registered under number 7 of 2007 Companies Act. There are public companies, there are private companies, then associations and clubs. There are other categories also. Right. In your paper, we take 99% of the companies for the credit analysis. Apart from the companies, it's very companies will play a bigger role when it comes to credit analysis than other people, other categories. Therefore, the main question will be based on credit analysis of a company. Right. Then one by one, if you take the things that we considered under credit analysis, individual, if you take credit facilities to individual will normally be considered based on their income, wealth, standing in the society, tax payments, and the conduct of bank account will view as evidence. Similar to individual under sole proprietorship also, apart from the things that we consider under individual, in addition, there should be some business. Therefore, considering credit facility will be similar to individual. Income will be based on business profit, right? Based on the business, what is there. Business registration, tax payment, conduct of bank account will be viewed as a proof of business income. Now, especially when it comes to these sole proprietorship category, you can see the poor accounting is happened. Normally, there is no accounting. They tend to, when it comes to this finalization of income tax returns, they tend to go to a part-time accountant and complete the accounts set by using their bank statement and prepare something and send it to the Inland Revenue Department. If something goes wrong, they will try to figure out some person in the Inland Revenue Department and give something and clear those things. Right? That is the normal happening in the sole proprietorship. Now they know as far as accounting is concerned, they know it's a things that they need to do at the year end, right? When it's come to filing of returns. But from the perspective of bank, you should, as far as possible, encourage these people to have some accounting. Put some part qualified person into these organizations, record their transactions, right? Now, even if you take the name suggests that the sole proprietorship it's small in scale, but when it comes to the practical situation, there can be businesses which are having good turnovers, right? And good profit, material profit. Therefore, the business will not last in a small scale for a particular time period. It will get to be more and more large in the scale and time to come. Therefore, in that case, they are worried about the accounting because the Inland Revenue people, they will push to have a better financial statement. Therefore, make sure that in a given time period, you ask these people to provide financial statement with good periodic accounting place in their business entities. And it is not a difficult task. When an assessment received from the Inland Revenue Department, some people, some businesses will get affected badly. Therefore, in order to avoid those things from the beginning of the particular year, try to have some accounting evaluations. You should put some people into effect to record these transactions, to collect these transactions, and analyze and prepare the financial statement on a periodic basis, on a monthly basis. Otherwise, these people won't know whether they are in a profitable situation. Not only to provide the statements to the bank, not only to provide the statements to the inner revenue department. In order to get an understanding about their business, these people should have the accounting technique. At last week I explained, if you don't have accounting, then you don't know whether you have what kind of expenses, income, whether you are in a profit category or loss category, the liability that you have to settle, asset that you are owning, right? No records at all. Therefore, encourage these, especially the sole proprietorships individual. If they are doing a business, definitely they should have some accounting under their umbrella, right? Then under partnership, there is a partnership ordinance 1890, and we should, as bankers, we should ask for a partnership agreement. If there is no partnership agreement, you can have a partnership without a partnership agreement according to this ordinance, but encourage all the people in the partnership, the partners, to have a partnership agreement before you lend to them, because it will resolve a lot of problems under partnership. Partnership agreement will say the profit sharing, the capital sharing, and the salaries, interest on capital. With how do you take decision when it comes to appointment of a new partner, or how do you account all the things when it comes to retirement of a partner, right? Therefore, the partnership agreement will play a bigger role in a partnership, because there can be some disputes among partners. In those cases, what we have to follow is the points that we have laid down in the partnership agreement, right? If there is no partnership agreement, and if there is no things mentioned, particular things have not been mentioned in the said partnership agreement, there is a way out. In the 1890 partnership ordinance, there is a section called section 24. Under section 24, what we have to do is we can apply the points in the section 24 under two situations where you don't have a partnership agreement. Then the second situation, that is, you have a partnership agreement and the particular point, it is not clear in the, or it is not included in the said partnership agreement. In that case, the section 24, whatever the points laid down in the section 24, you have to apply. That is the law, right? For example, say the profit sharing ratio of partners is not stated in the partnership agreement, then you have to go to the section 24 1890 partnership ordinance. It says the profit should be shared equally among the partners, right? And in partnership agreement, there are a lot of things to be included. Therefore, you have to have a partnership agreement when you are lending to a partnership. Then business registration, tax payment, conduct of bank account, and if you take the legal action against the partnership, you cannot take the legal actions against the partnership, because since there is no legal entity, therefore every action should be taken against the partners instead of taking actions against the partnership, right? Then the next category is the companies. Currently, companies are governed by the number 7 of 2007 Companies Act, and it was came into light in 3rd May 2007. And if you compare with the partnership and sole proprietorship, the benefits and the advantages what we can gain by having a company is, if you take the first point, there is a legal entity. Legal entity means in front of law, company will be recognized as a person. Therefore, company can take against any person in their name, or any person can take actions against the company in the company's name, and the company can open accounts, acquire properties in their name, right? Then second point, liability of members, that is shareholders. If you take a company, the members are called shareholders. Their liability is limited to the extent of capital contribution, right? Whatever the capital they have contributed, if something goes wrong, they only liable for that amount of money, right? Not in the capacity of personal liability. Therefore, that is also an advantage. Then number 3 is no limitation of number of person contributing to the capital. Take a company, you can have any number of persons. If you take private company, there is a restriction, but if you take public company, there is no limitation. And not only that, you can publicly ask the people or the contributors who are willing to contribute their money to a particular company. The particular company can publicly ask those people to send their money or contribute their capital to this particular company. Right, that is also an advantage. Then these are a few points that came into light with the implementation of this 2007 Act. Actually, this is not a new act. Now it's almost 14 years. But I thought of explaining these points as well. If you take the previous Company Act, that is 1982 number 17 Company Act, there was a concept called par value or nominal value, right? Where it's like you have a face value to a share, right? Face value to a share, and if the face value is say 10 rupee, the face value might be 100 rupee. You get your dividend based on the face value, but the actual price may be different from the face value. Those concepts were there under previous Company Act, but this new Company Act 2007 one, they take off those all those concepts, and they said the capital should be renamed as stated capital. And currently now there is no par value, nominal value. We can have only the issue price of a share. And if you take the stated capital, issue price into number of shares, that will equal to the stated capital of that particular company. Then under previous Company Act, there were main two documents, that is Memorandum of Association and Articles of Association, right? When you want to register a company, those two documents will have to be submitted to the Register of Companies. The Memorandum of Association, it will include all the objectives of that company. What are the areas to we are going to do our businesses, right? Those are called objective of the business. Then articles meant to say that the powers and the rules and other regulations of that particular entity. Therefore, when it comes to this new Company Act, this Memorandum of Association, they say they need not to require that document. There was a point that why they have taken off that particular document. Under new Company Act, if you take the previous Company Act, companies only can do their business only to the areas that they have mentioned under the Memorandum of Association as objectives, right? If you define your objectives to a particular area, the company can only do that business under Memorandum of Association under previous regime, that is 1982 Act. But when it comes to new Company Act, they said no need to define objectives of the company. Any company do any area of business. There is no restriction of business under new Company Act. Now, if I take an example, under previous regime, that is 1982 Company Act, if a bank defined that we are only doing banking, they are, in that case, they cannot do insurance business, right? But If they have defined, they are not only doing banking, they also doing insurance under memorandum of association, they could do that. But under New Company Act 2007 1, there is no restriction bank or any entity to do any business at all. Right? Therefore, no need of this particular document, that is memorandum of association. Currently the only main document we consider for registration is articles of association, right? Then no limitation of issued capital. Under previous regime, there was a when you register your company, you have to say this is the amount of capital what we are going to issue. That is called the term we used to say is authorized share capital. Authorized share capital. According to the New Company Act, that is 2007 1, there is no restriction for that. Therefore, the concept also taken off authorized share capital. A company can issue any amount of capital if they are capable of raising those capitals, right? Therefore, no limitation of issued capital. Similarly, this point I already explained, no limitation of business activities of the company. That's why we taken off that memorandum of association. Then articles of association provide the details of company and also rules and regulation governing the activities of the company, right? And the last point, the first schedule provides a model set of articles. You can follow those model set of articles. If you are interested of opening a company, there is a model set of articles given in the first schedule. Right. If you take companies, there can be limited liability companies, unlimited liability companies, limited by guarantee companies, and there are some categories. Secretary to the Treasury on behalf of the government has powers to incorporate single shareholder company also. I am not going to explain these things. If you are interested, you can download the Company Act and go to these sections and get an understanding, because I am not going to test these things under my purview. Right. Then shares in a company, section 49 also provides a issue of different class of shares with different rights. Normally there are mainly two categories: ordinary share capital, which has the voting right of the company. Then preference shares, they do have, they don't have the voting right, but they do have fixed amount of dividend attached to the particular preference share. No share will have a nominal value formula already discussed. Shares in a company shall be transferred in the manner provided in the article section 49(5). If there is no restriction on the transfer of shares, it is termed a public company. Such company should use public limited company along with their name. Right. If you take the public company, there is no restriction of transferring the shares, right? And not only that, they can openly invite any person in Sri Lanka to contribute to their share capital by having a opening announcement. We can ask the particular company, public limited company, can ask any person in Sri Lanka to contribute their capital openly. Those are called public limited company, and there is no restriction in the transfer of shares. Most of the public limited companies will get listed in the Colombo Stock Exchange, and in order to have more transparency and more marketing for the share prices, once you get registered with the Colombo Stock Exchange, the shareholders will get a chance to buy shares, sell shares using the platform of the CSA. Then continue the shares in a company. If a company prohibits offering shares to public section, public section 27A, then it is termed as a private limited company. Such company should use the private company limited or PVT limited along with their name, right? I think no need to explain those points. Shares may be issued for cash or consideration as decided by the board. These are some salient points I have taken from the Companies Act. You have to get an understanding about these points, not only to pass the exam. Most probably, I am not going to test these things in the exam, but you get a better understanding of the companies and the companies registered under Companies Act. Where shares are issued for consideration other than cash, the board of directors shall determine the cash value of such consideration for the above purposes and take that into account into account in calculating the stated capital. Now, these days, all the banks are preparing their annual report. This is a point that you should note under accounting records. If you take section 148, board of directors must ensure that the company, number one, these sections are very important. Now almost all the companies should publish, almost all the banks should publish their figures this week, because there's a requirement to publish the year-end financial within 2 months of the end of financial year. Therefore, 28 February is the deadline. And not only that, they will have to have a AGM also. In order to do the AGM, you have to send 15 days prior to the AGM the financial statement or the annual report of the particular bank. Therefore, all the banks, they are working very hard to complete or achieve those deadlines. Why they do is because of these sections under Company Act. If you take there's a 2 months restrictions from the Security and Exchange Commission, but under Company Act also for the financial statement there is a deadline. But if it is a listed company, they have to again follow the CSC and SEC ruling when it comes to financial statement. We are not going to in detail talk about those ruling. We will only focus on the Companies Act requirement. If I come to the this particular slide again, section 148, the board of directors must ensure that the company, number one, correctly record and explain the transaction. Right? In order to correctly record and explain the transaction, there should be a process of identifying the transaction. Collection should be there, recording should be there, categorization, right? Summarization, analyze, everything should be there. Meaning to say, there should be a proper accounting technique. Therefore, all the, if you take banks, they do have this core banking systems operated throughout the 24 hours and 365 days. Then if it is a company other than a bank, they are also, there should be a proper way of collecting the accounting information and explain those transactions in the books of accounts. That is a requirement under 148 of the Companies Act. Then number two, financial statement should be prepared by a responsible person. Normally we call CFO, Chief Financial Officer, who should certify that the financial statement for compliance with the Act, right? If you go to the financial statements, you can easily get an access to your financial statements of your bank. In the balance sheet itself, the CFO, he certify the financial statement. That is a requirement from the Company Act under section 148, right? Under section 148. Every financial statement should be certified by the CFO under Company Act, this particular section. what is the requirement? He has to certify that the financial statements are compliant with this particular company act, right? That certification should be given by the CFO. And not only that, not only CFO, there should be two directors on behalf of the board. Two directors should sign the financial statements, right? You can say initially signed by the CFO, then signed by the maybe chairman, deputy chairman, or the MD, and finally the company secretary, right? Has to sign the financial statements. Normally, it will be signed on the face of the balance sheet. If you go to your financial statement of your bank, you can easily recognize this requirement. Then financial position means the balance sheet determined at any time with the responsible accuracy, right? Anytime you can determine the accuracy whether it is okay or not. And last point, financial statement readily and properly audited by stipulated auditors, right? Normally there is an act called number 15 of 1995, Accounting and Auditing Standard Act. Act number 15 of 1995, Accounting and Auditing Standard Act. In that act, they give powers to the Institute of Chartered Accountants of Sri Lanka to prepare and submit, get an approval for the accounting standard. And they also, in the act, they recognize entities called specified business entities, right? They say particular name, all the business entities, they categorize into specified business entities. Normally, these specified business entities, they will have all the big and large companies in Sri Lanka. For example, under the definition of specified business entities, they say it includes, those companies should include all the banks registered under the Banking Act. Then they said all the insurance companies under Insurance Act, right? All the finance companies under Finance Act. Then the people who are in the leasing business. Then all listed companies listed in the Colombo Stock Exchange, right? Not only that, they said under that particular act, it meant to say if a company has more than 1,000 people employed, that is also a specified business entity. Then I can't exactly remember the figures. If you have total assets more than say 100 billion, right? That is also a specified business entity, right? Therefore, almost all the big and large companies will categorize as a specified business entities under this particular act. The requirement for a specified business entity is there are two requirements. Number one is to prepare their financial statements in accordance with the Sri Lanka accounting standard. That is the first requirement. Then the number two requirement is to get them audited. The financial statements should be audited by a qualified chartered accountant, right? Those are the two requirements. Therefore, this last point, financial statement readily and properly audited by the stipulated auditors. Every company should get audited their financial statements by using a proper auditor at the every year end. Right. This is also a very important section under Company Act. If you take this section 151, 151, every company shall prepare financial statements within 6 months of the end of the financial year or within any extended time determined by the Registrar of Companies, right? Actually, according to the Company Act, a company have been given 6 months period after the end of the financial year, additional 6-month period is there to prepare financial statement and get them audited. But a few minutes ago, I mentioned that there is a requirement for every bank to prepare the financial statements and prepare the annual report before these 28th February, prepare the financial statements, not the annual report. That is a requirement coming from the Security and Exchange Commission and the Colombo Stock Exchange, right? According to the CSE ruling, there is a deadline of 2 months for every listed company to prepare the financial statements and to present the financial statements in the CSE web. If you take the annual financial statements, that is a different requirement. But if you are not a listed company, you have a 6-month period. But if you are a listed company, you have only 2 months period to prepare your annual financial statements. Then not only that, an annual return must be filled with the register of companies along with the audited financial statements. In the annual return, not only the audited financial statement, there are some other reports to be included. For non-compliance, every director in default shall be guilty and liable for fine of 100,000. If you have 12 directors, you have 1.2 million fine, right? Section 152 provides similar provision for group financial statements as well. And this is specifically for this requirement under section 166, specifically for public limited companies. Every public limited company, the board of every public limited company shall within 6 months after the balance sheet date prepare a statement called annual report on the affairs of the company using the accounting period. During the accounting period. Annual report should be sent to the every shareholder 15 working days prior to the date of the annual general meeting, right? Normally every bank have their AGM before the 31st March because they in their financial year 31st December they have their AGM before the 31st March, right? In order to have the AGM 31st March, they should send this particular annual report document before 15 working days, right? If you take 15 working days, normally in total, if you take all the holidays into account, it may be more than 20-25 days, right? Say 20 days. Therefore, if you take a bank before to have a AGM 31st March, right? They should send this particular document at least by 10th March to every shareholder, right? 10th March to every shareholder. The document, the annual report, can be sent as a hard copy or as a CD or as a email form or a soft copy form, right? Normally very little shareholders are asking for the hard copy. They most of the people previously asked for the CD. Nowadays they have access to this particular document via internet and web. Therefore, in order to have the AGM 31st March, you should send this particular document because of this 15 days working day requirement at least 10th March, right? In order to send the document to the 10th March, you should prepare this document, right? And if it is a printing requirement, you should print this document because there are some hard copies to be sent to the shareholders, right? Therefore, it will take also some time. say for the print in 2 weeks, therefore at least 25th of February or 20th of February, we have to complete this document from the bank side, right? And hand it over to the printer, right? Therefore, these days, if you take banks, these days they are working very hard on this annual report, and they have a deadline normally ranging from 20th February to 28th February to sign off all these annual report documents. Once you sign off all these annual report documents, annual report from the bank side, then it will go to the printer. It will take 2 weeks. Then thereafter, after 2 weeks, the hard copies you can find and you can find, and you can have the soft copy also. Then it will be sent to the shareholders before the 15 working days prior to the AGM date. That is, normally AGM will be held on 31st March, right? Therefore, it is a very cumbersome, time-taking process, very strict to the deadlines. And you have to follow all these deadlines if you want to have the AGM on a particular date. But if you are not a listed company, you have if you are a public company, you have a 6-month period, right? You have a 6-month period to according to the Company Act. You have a 6-month period. If you decide to have the AGM after 31st March, then there is some period where you can have the AGM, but normally people, every bank prefer to have their AGM before the 31st March. That is a custom. But the normal requirements under Company Act, public company shall within 6 months after balance sheet date prepare the annual report and send it to the shareholders. Right. Under section 168, content of the annual report. Company Act also talks about the content of the annual report. Annual report is the main document for every company. It should not always have the accounts of the entity. It should have various other information also. First point is the company's nature of the business and type of business. Then signed financial statement of the company for the accounting period and group financial statement. We know that it's a month's document, financial statement to be included in the annual report. Then auditors report on financial statements. Now, normally these financial statements should get audited, and their report should also be included in the annual report. Then any changes in accounting policies. If there are changes in the accounting policy, you have to include those things as well. Then particulars of entries in the interest register. Last week also we discussed. Then remuneration and benefits to the directors. Then depreciation provided in the financial statements. Total amount of donation made by the company. Audit fee and non-audit fee. Names of person holding position as directors. Signed by 2 directors of the company. All these requirements, whether it is small, big, or material or immaterial, you should provide these things in the annual report. For example, say if you take a bank, the bank's financial figures are in billions, right? In billions. But take the item, this audit fees, even though it's in millions, we are reporting in billions. Even though audit fees in millions, whether it is 1 million, 2 million, doesn't matter. You have to specifically stated these figures, audit fees, in the face of financial statement. That is a requirement under Company Act. Right. I think last week we stopped at this point. This is called distribution. Under distribution, if you take company, there is main one distribution is there. That is called dividend. Right? අපි සිංහලෙන් කියනවා ලාභාංශ කියලා. The board of directors are required to always be mindful and conscious of the solvency of the company. When you are distributing something from the company to the shareholders, right? When you are distributing something or some funds from the company to the shareholders, there's a requirement as board of directors, you have to consider the concept of solvency before that distribution. Normally in a company, dividend will be distributed among shareholders. If it is a big company, these dividends may amount to billions. Therefore, before you distribute these billions rupees, there is a check and accuracy process that is called solvency test, right? The company required to get a solvency test confirmed by the external auditors and before every distribution of these dividends, right? The concept of distribution in terms of the act consists of transfer of cash or property other than shares of a company, incurring a debt to or any benefit on behalf of the shareholder, right? These are the things that we can consider as distributions. When considering the shares held by a person, the distribution includes dividend payments, redemption of shares, that is you redeem all the shares, you give money and redeem those shares of the shareholders. Then reduction of shareholders' liability by way of paying cash, distribution of indebtedness or debentures. Redemption of shares amount to a reduction of capital. A special resolution to such an amount the directors think appropriate. Public notice shall be given at least 60 days before the resolution. No need to obtain court sanction. Right. Now we have to last paper I also check this solvency thing. Therefore, you have to have a better understanding about the solvency requirement, how you calculate the solvency test for a particular company. Right. In terms of section 57.2, in determining whether the company satisfies the solvency test, the board shall take into account these things. Number one, the most recent financial statement prepared in terms of section 151. Then the circumstances the directors know or ought to know which affects the value of company's asset and liabilities, right? Once you distribute these shares, once you distribute these funds among shareholders, what will happen to the asset and liability of the company? And a fair valuation or other methods of assessing the values of the asset and liability, right? Now, this is the test you have to do before distribution of a dividend issue, right? There are two things you have to satisfy before the distribution. You should get 2 green lights for these two things, right? If you get 1 green light for point number 1 and second point, if you get a red light, you cannot pass the test, right? In order to get passed through this particular solvency test, you have to pass these 2 points, right? Number one is your ability to pay debts in normal course of business. How you satisfy this particular point, you have to see whether the current assets of the particular company is more than the current liabilities. Current assets of the particular company is more than the current liability. That is one thing. Then the point number 2, that point number 1 very easily you can detect, right? Point number 2, value of entities assets, right? You have to take the total assets less liabilities less stated capital and proposed dividend. What is the missing item here? If you take a balance sheet, you have the assets and the other side you have liabilities and equity. Under equity, you have stated capital And here another one is proposed dividend, that is also liability. What is the missing item? Total asset, go to the second formula, total assets should more than the total liability plus stated capital. Normally in a balance sheet, total assets equal total liability plus equity. Equity comprised of two parts in a company. What are the two parts? Stated capital plus
Retained profit.
Retained profit. Very good. Retained profit. If you take the bigger picture, not only the retained profit, all the reserves. You have this revaluation reserve. You have this other reserves. You have this what is called general reserve, retained profit. Everything we call reserves. Therefore, the second point emphasize, before you distribute any dividend, you should have adequate reserves, right? You should have adequate reserves. How do you get to know about the adequacy of the reserves? You have to use the formula. Your total asset should be more than total liability plus stated capital, right? The missing item here is the reserves, right? Therefore, in a nutshell, the 2 points that you have to take into account is, number one, the current asset should be more than the current liability. That is the first green line you have to see. Then the number two, you should have adequate reserves before a distribution of dividend. If you don't have adequate reserves, you cannot declare dividends. How do you establish that point? Your total assets should be more than the total liability plus stated capital. Right. With this background, we will do a scenario analysis also in later stage. How do you calculate the solvency test? Right. Then up to now, if you do have any question, you can raise. Right. Yes.
Excuse me, sir.
Yes.
Can you please explain again the second point of the solvency test
Yes.
part?
Yes. Okay. Okay, dear. Right. Okay. Now, if you go to the second point, if you take a balance sheet of a business, last week, if you can remember, I'll go to this slide. Here, you can remember assets equal liability plus equity, right? If you take equity of a company comprises of mainly two parts. That is stated capital plus reserves. Reserves means undistributed retained profit of that company, right? When you are to distribute some dividends, there should be retained profits or the reserves, right? If you don't have reserves, you cannot distribute the dividends. That's why normally this will get the equation will get tally, assets equal liability plus equity. That's why we have introduced here. Now, if you go to this formula, total assets should more than the total liability plus stated capital. Here the missing item is reserves. If you add to the stated capital the reserves, this formula will get tally. Total assets equal total liability plus stated capital plus reserves, right? Therefore, the missing item is reserve, right? In order to see whether we have adequate reserves, we use this formula, right? If you do have reserves, you can only declare dividend.
Thank you, sir.
Okay. Make sure that you take into account the proposed dividend also as liability when you're calculating the second part, right? Here, go to the point, value of the entities, assets and liability. Sorry, value of the entities, assets, less liabilities, less stated capital, and proposed dividend. Right?
Thank you, sir.
Okay. Right. If there is no question, I can take the next points. This is also very important section, understanding the client business. Understanding the client business. Now, when you are doing a credit proposal, if you don't understand the client business properly, the proper credit proposal will not come to light. Knowledge of client business is necessary in the process of analyzing the credit worthiness and to assess the level of risk involved. Right? Say, for example, take now you are going to provide the loan facility to a coconut state, right? A person having a business person having a coconut state, and he is asking for a loan. If you don't know about the business of coconut, right? State business, coconut state business, then a proper credit analysis cannot be done with the intention of providing information to a higher authority. Therefore, the point number 2, essential components are business background and nature of business. That is very important. If you come across new business areas, you have to gain some knowledge about the business. If you don't know about that business, you cannot properly do a credit analysis. And maybe you may do a proper, you may do a analysis on the business, but there can be material misstatements or material errors. Then point number 2, macroeconomic factors sensitive to the business. Not only to the current business, take all the macroeconomic factors which may have sensitive to the business that you are going to propose a loan. Therefore, having good business understanding about the particular area is of utmost importance when you are doing a credit analysis. Then product, service quality, marketability, trading outlook, you have to have a good understanding, right? If you don't have good understanding, make sure that you get some understanding. It might be through internet, it might be through field visit, it might be through one of your friends, calling them. The important thing is here, if you don't understand the business, you have to physically visit there. If you are going to provide loan facilities to polythene manufacturing companies, say these shopping bags, every bag, they are doing polythene manufacturing, right? Now they are using, because I got used to have worked before I joined the university, and also during my university tenure, I used to go to a polythene manufacturing company as a part-time accountant, right? Because I want to earn some money for my education. I went to as a part-time accountant for one of these companies in Colombo. Then I know the background of how the polythene bags are being produced, what are the material used. If you take a master badge means the material that we use to prepare the polythene bag. It is important from the, normally we import those things from the Middle East countries. And the process, the machines that we use, the how the polythene bag will get manufactured, right? Now, when I see the financial statement provided by the particular entity, normally I dream about the background and the nature of the business in my mind when I am evaluating the financial statement. If you don't know about the business, it is very difficult to analyze the financial statements, right? Definitely a good analysis, good financial statement analysis can be done when you do have a business understanding and a business background of a particular industry, right? If you go to the tea industry, different jargons, different areas, different understanding should be gained before analyzing the financial statements of the tea industry. Make sure that you gain that knowledge, right? In order to have this kind of a thing among the business people of the entity, normally the big companies, if you take this corporate category, normally all the banks are now having specialized areas for the corporate category. For example, say if you take the trading category of the corporates, it will be handled by a separate relationship manager. Then if you take hospitals, all the hospital facilities will be handled by a separate relationship manager. If it is leisure, the hotel and everything, it will be handled by a separate relationship manager. Similarly, construction, education, say tea plantation, coconut plantation, right? Specialized relationship managers will be appointed because that particular industry needs particular knowledge and understanding about the industry. Therefore, almost all the banks are now practicing that specialization category among the top corporate. But when it comes to retail, it is very difficult. The brand managers in the retail business have to have multiple knowledge. If you do have different clients falling into the different business, right? Therefore, understanding of client business is very important before you analyze the financial statements. I'm not going to explain this slide because I have already explained this thing. Definition, if you take the financial statement definition, the objective of the financial statement is to provide information about the reporting entities' financial position. Underline these two words. Financial performance means profit or loss. And the financial position means asset liabilities, about the asset liabilities, right? Financial performance and the financial position that is useful to a wide range of users for assessing the stewardship of the entity's management and for making economic decision. Now, these are the accounting standards that we define to have a proper preparation of financial statement. All the accountants should follow these accounting standards. International accounting standard, set of guidelines prepared by the Accounting Standard Board, that is International Accounting Standard Board. Especially when it comes to the preparation of presentation of financial statement of foreign entity as well. Then our case, we have an act called 1995 number 15. I already mentioned this act, and it gave all the powers to the Institute of Chartered Accountants of Sri Lanka to have implemented this accounting standard. There you have what is called Accounting Standard Committee, which comprise of all the by and large the chartered accountants, and they will implement new accounting standard. They will abolish the old accounting standard. They will make amendments to the existing accounting standards. Those are called Sri Lanka Accounting Standard. Nowadays, it is termed as LKS, Lanka Accounting Standard, and SLFRS, Sri Lanka Financial Reporting Standards. Last week, we discussed in detail. Right. With a view to reflect fair value of assets and liabilities in the balance sheet, changes were made to the guideline by the Accounting Standard Boards and implemented 1/1/2012 as International Financial Reporting Standard (IFRS). Sri Lanka adopted the following changes and implemented from 1st January 2012. Sri Lanka Financial Reporting Standard (SLFRS) and Sri Lanka Accounting Standard (LKS). Right. This is the repetition of the same slide. Then we discussed this thing a week ago also. A component of a financial statement. If you take the complete set of the financial statement, it should include 6 statements. that is a statement of financial position, that is called balance sheet. Then statement of comprehensive income, that is called income statement or the P&L. Then the third statement is statement of changes in equity. Fourth one, statement of cash flow statement. Number 5 and 6 get together. Notes to the comprising accounting policies and explanatory information. Accounting notes and accounting policies. Right. To go to the financial position, normally we say statement of financial position, and the famous name is the balance sheet. It includes assets, right? Assets, liabilities, and equity. Last week we discussed those 5 items. Income and expenses will go to the income statement. Asset, liability, and equity will come to the balance sheet or the statement of financial performance. Normally under assets, we have non-current assets, mainly comprised of the property, plant, and equipments like land, building, machinery, furniture, vehicles, right? Those assets need to be depreciated. Most of the asset needs to be depreciated apart from the land. Normally lands are not depreciable assets. Therefore, when it comes to depreciation, there should be a cost, there should be accumulated depreciation, and net book value should be there. Then assets also comprise of long-term investments. Then investment with more than 1 year, those are called non-current assets. Then under current assets, you have these inventories, trade receivables, then prepayments, cash and bank balances. Those are called current assets. Last week also we defined if an asset is giving us a short-term income generation, those are called current assets. If an asset generating more than 1 year period income, we call those assets as non-current assets. Normally, every asset should generate income to the organization directly or indirectly, short term or long term. That is the requirement. Then, if you take the other side, that is liability and equity. Under liability and equity, first, if you take the shareholders' equity and reserves, under shareholders' equity and reserves, we have stated capital, then reserves, and the retained earnings, the undistributed profits. Then under liability, we have 2 categories, non-current liabilities and current liabilities. If a liability will get set off within 1 year, we call that liability as current liability. If it takes more than 1 year period to set off the liability, we consider that liability as a non-current liability. Normally in a company, long-term loans, debentures, retirement benefits are called non-current liabilities. Accrued expenses, tax payables, bank overdraft, those are called current liabilities. Right. Then we'll come to the income statement of a company. Under income statement, there are mainly 2 categories. First part we call the income statement. The second part we call other comprehensive income statement. Other comprehensive income statement, right? This particular change was done to the income statement with effect from 1st January 2012. 1st January 2012. Normal nature business income and expenses will come to the income statement. If it is a capital nature income or expense or gain or loss, capital nature income or gain or loss, it will go to the other comprehensive income, right? What is important is if you are to analyze, if you are to take the normal business profit, please take the income statement, the last item, that is profit after tax, right? Other comprehensive income will talk about the capital nature gains and profits. Normally, we do not take into account those things other than for information purpose. Therefore, what you have to worry about the income statement, right? What we have to worry about the income statement, that is profit after, up to starting from sales up to profit after tax, right? Therefore, normal business income and expenses will get reflected in the income statement. The two statement we call comprehensive income statement, right? Comprehensive income statement has two parts. First part is income statement, which is starting from sales, ending with profit after tax. Then the balance part is called other comprehensive income statement. That is starting from profit after tax, and which will be all the capital nature gains and losses will be included in the other comprehensive income statement, right? But the point to remember is when you are analyzing, take the income statement figures which is starting from sales and ending with profit after tax. Those are normal business profits. This is the other comprehensive income statement. It starts with the net profit after tax and end with total comprehensive income. Normally, this will include all the capital nature income and expenses, all the gains and losses. For example, if you take that, these are very technical terminologies. I don't have time to explain these things also. And the proper understanding, if you are to get the proper understanding, you have to have a good technical knowledge. Normally, the simple thing that I can explain is the revaluation gain and loss, right? If you take revaluation gains and loss, revaluation gains and losses are long-term gains and losses. For example, say IBSL has this building. Now, this was acquired or built about 5 years back for a cost of 1 billion, right? And now assume that current valuation says this building worth 3 billion. Then your price of this building from 1 billion, it has increased to 3 billion. Therefore, there is a gain of 2 billion. You cannot put that 2 billion into your income statement as a gain. Instead, it should be recognized in this other comprehensive income statement as a gain. I mentioned other comprehensive income will only recognize the capital nature gains and losses. But when you come to income statement, it will be taken care of the normal business activities, not the capital nature income and expenses. Therefore, make sure that you correctly understand these 2 points. In your clients also, when they prepare and publish or presented the financial statements to you, make sure you have excluded the capital nature item in the income statement, and those things need to be included in the other comprehensive income statement. Then statement of changes in equity. I explain equity comprised of 2 parts, mainly stated capital plus reserves. Normally, in a company, reserves can be of different type. Statutory reserve funds, retained earnings, revaluation reserves, then what is called general reserves, right? Now, this statement of changes in equity, elaborate how your equity from the starting of the year to the end of the year, how it has been changed, right? What is the beginning equity, what is the end equity, and the changes incorporate in between, right? Those things will be elaborated in the statement of changes in equity, right? In this statement, the movement of changes from the balance sheet at the beginning of the year to the balance at the end of the year on equity items are shown. Equity items will include stated capital, capital reserves, revenue reserves. In the revenue reserve column, balance of the retained earnings brought forward from the previous year, current year comprehensive income transferred to the reserves, revaluation reserve, dividend payment will be shown. This is the some kind of format. If you take these columns, stated capital, capital reserve, retained earning, revaluation reserve, revaluation reserve is there. We take the balance at the beginning and the changes to the reserves and the balance at the end. Then statement of cash flows. Cash flows also a very important statement, but normally people don't pay much attention to this particular statement. Now, if you take all other statements, apart from the cash flow statement, all other statements are prepared based on accrual concept. What is accrual concept? Accrual concept means if you take an income, whether it is received or not, we take that item as income if it is fallen to the particular financial year. Similarly, when it comes to expense, whether it is paid or not, we will consider that amount as a expense if that particular expense is incurred during particular financial year. Therefore, the cash concept is ignored as far as preparation of financial statement is concerned under accrual concept. But cash flow statement is prepared based on cash concept. We only take cash receipt and cash payments. And the main three categories, what is called operating activities, investment activities, and financing activities, right? Normally, most of the people, including bankers, they just merely go through the cash flow statement. They don't see the benefits while analyzing the cash flow statement of a particular client. Cash flow statement will review by and large most of the things that you want as a banker, right? Therefore, you need to go through the cash flow statement and you need to understand better the cash flow statement and put more effort to the cash flow statement of a particular client. It will show how efficient your client in managing cash. There can be profit, but there can be no cash situations. We can see people, some company, they do have higher profit, but they are not declaring dividend because of cash issues, right? Therefore, the profit and the cash is two different concepts. You have to have a strike between these two balances, right? Therefore, there is a very important matter when you are analyzing the cash flow statement. Ask cash flow. Normally, when you lend money to the business clients, normally you ask cash flow statement, but that is based on different concept. When you receive the set of financial statement, if you don't have the cash flow statement, ask the client to prepare the cash flow statement again and provide it to you, right? Cash flow statement reveal very important cash inflows, cash outflows in different categories under investment, operating, financing activities. What is the beginning of the cash? What has happened to the entity, right? This is a very not materially considered in statement in the financial statement. Therefore, very important thing for you to consider when a set of financial statements are presented to you by a client. Then final two things are accounting policies and accounting notes. Accounting policies means the policies or the concept based on which you prepare the financial statements. For example, say if you take this depreciation. Depreciations can be applied in different rates. For example, if you take these motor vehicle depreciation can be of 20%, 10%, based on reducing balance method, based on straight line method, right? Therefore, you have to see what is your client's accounting policy for depreciation, right? And these accounting policies should be consistently applied from 1 year to another, right? If it is not consistently applied, you cannot compare and contrast the two financial statements. Therefore, what is important here also, you cannot change frequently the accounting policy for one item in a financial year for the benefit of the clients, right? Therefore, there should be a consistency in applying the accounting policies. Normally, people don't read these accounting policies. Especially when it comes to credit evaluation, you should read these accounting policies. Accounting policy for income, accounting policy for expenses, accounting policy for depreciation, accounting policy for provisioning, right? They should include these things and they should properly declare their policy on everything. Events after the balance sheet date, prudence concept, everything should be clearly stated. Accounting errors. Don't just take these financial statements and forget about the accounting policy. You have to read those accounting policies, then you can get an understanding how this particular client have accounted the items in the trial balance to the financial statements. Then notes to the accounts. Notes to the accounts also very important. The main financial statement items are income statement and the statement of financial position. What we give in the note is you additionally explain those items which we need additional explanation in the accounting note. For example, say in the sales normally we presented in the income statement. If you have a note to the sales in the latter part, you can give details about the sales. For example, in province wise, what is the sales, right? In region wise, what is the sales, right? Whether it is local or foreign, if you do have local sales and foreign sales, what are the categories, right? Anything similarly, if you take the property, plant and equipment in the balance sheet, we have one figure, right? You go to the notes and you can see property, plant and equipment which comprise of land, building, machinery, and where you can see the new acquisition, you can see the disposal. If they have a revaluation, you can see those things. That is coming under notes. There was a question raised by one person. There is no partnership agreement. What will happen to a loan given to a partnership? Then what is the liability of a partners? Since there is no legal entity, there is no option. You have to file case against the individual partners for liabilities. What is important here is, if there is a partnership agreement, not only for liability side, but when there are disputes among partners, when there are difficulties from the perspective of partnership itself, it should be a must document. Now, in writing, the share of capital, share of profit, interest on capital, new appointment of a new partner, retirement of a partner, everything should be in the partnership agreement. Then it will be very easy to do the business within the partnership itself. And from the bank's point of view, if there are whether it is agreement is there or not, that is not a fact when it comes to filing against for non-repayment of loan. If there is a default, we have to fine against the individual partners, not for the partnership. That is not a case where you do have a partnership agreement or whether you don't not have a partnership agreements. In a partnership, since there is no legal entity, you must file against individual partners. But taking into account the other benefits that you can have by having a partnership agreement, it's very important to lend to a partnership where you do have the partnership agreement. Right. I will go to the tude number 3. I think all these tudes are uploaded into your session. And there were a few questions raised to upload the this video session also immediately after the lecture. I will ask them to do the same. To take the financial statement analysis and the tools that we are used, we'll take point by point. Financial statement analysis is one source of information for assessing risk and returns, right? Along with other points, along with other tools, financial statement analysis is also one critical part in analyzing the risk and return of a particular client. The application of analytical tools and the techniques to financial statement data for analysis is very critical. Allows user to focus on how numbers are related and how they have changed over the time to assess the risk involved and lending. Right. Now, main tools that we use to analyze the financial statements for the purpose of this lending. First one is the horizontal analysis. Second one is the vertical analysis. And third one is the ratio analysis. Even though you don't know about the terms horizontal analysis, vertical analysis, you know the ratio analysis. But you in day-to-day life, you use these techniques, horizontal and verticals, right? One by one, we will explain and get an understanding about these individual techniques. If you do have any question, please stop me and ask that question, right? Don't worry about the size, nature, and the complexity of the question, whether it is a simple question or very complex question. Please ask the question. I will try my level best to give an answer. And if I don't know the answer, I will come back and give you the answer. Right. We'll take first horizontal analysis. Actually, from this point onwards, all the things that I am going to discuss is very important for the examination perspective. That is nothing to say about what we have discussed up to now won't be tested in the exam. But if you take this point onward, the point that I am going to discuss, there is a higher percentage of chance to these points to be checked in the exam. Right. First technique, horizontal analysis. We have to take amounts and percentage of change. We have to take the amount and the percentage of change. Now, how do you calculate? The calculation method is there. First, you take the amount of change. You take the late year amount and earlier year amount. We'll take assume that we are analyzing the 2020 financial. Later year amount is the 2020 amount. Earlier year amount is the 2019 year amount. Right? Then percentage change, amount of change, take the amount of change, divided it by earlier amount into 100. For example, in 2020, sales is 200 million. In 2019, sales is 150 million. Then the amount of change is 2020 amount minus 2019 amount, that is 50 million. Then percentage of change, you take the amount of change, that is 50 million, divided it by 2019 amount, that is 150 million into 100. That is how you calculate the horizontal analysis. We'll take some example and see how we calculate the ratios. Right. Look at this thing in the screen. Right. This is the profit for the year ended 30th June 2017. All figures are in millions. The figures are demarcated into two main categories, current period and previous period. Right? Under current period, they have compared actual figure with the budget and take the variance against budget and the percentage of that. And in the previous year columns, current year actual was compared with the previous year actual, and they take the variance and the percentage. Right, one by one we can discuss. If you take the interest income, current year period, the interest income is 3,600. Right, current year income, interest income 3,600. The budgeted for the current year is 3,500. Therefore, variance against budget is 100. Variance against budget is 100. To take a percentage, 100 divided by 3,500 into 100, that is 2.86. 2.86. Higher than the budget. Then last year, for the same period, the interest income was 2,300. 2,300. Therefore, 3,600 minus 2,300, the variance is 1,300. Then an increase of 56%. 1,003 divided by 2,300 into 100, that is 56%. This is called horizontal analysis. Horizontal analysis. Similarly, if you take the profit after tax figure, PAT. PAT for the period 580. PAT budget 520. PAT previous year 420. Now compared to budget, there is an increase of 11.54%. Compared to previous year, there is an increase of 38%. 38% increase is there. This is called horizontal analysis. Horizontal analysis. If you do have any questions about the horizontal analysis, please raise. Are we okay about the horizontal analysis? You day to day do the horizontal analysis, but even though you don't know about the technical terminology, you always do this horizontal analysis. In your credit papers, you always emphasize these horizontal analysis figures. Right. Then we'll move to the vertical analysis. If you do have questions, please raise. ඔයගොල්ලෝගේ ඔළුවේ තියාගෙන ඉන්නවා ප්‍රශ්න තියෙනවා අහන්න. ඕනම භාෂාවකින් අහන්න පුළුවන් ඈ. එහෙම ප්‍රශ්නයක් නැහැ. තමිල් නම් මම දන්නේ නැහැ. තමිල් ඇරුණාම අනිත් ඕනම භාෂාවකින් අහන්න පුළුවන්. තමිල් උනත් ප්‍රශ්නේ අහන්න. තව කෙනෙකුට තමිල් තේරෙනවා නම් එයා ඉංග්‍රීසියෙන් හරි සිංහලෙන් හරි ඒවට ඒ ප්‍රශ්නයක් නැහැ. Right. Vertical analysis shows how each item in a financial statement compares to the total of that statement. This is also very simple to understand, but you have to have a proper knowledge on this. Right. If you take balance sheet as a main statement or the statement of financial position, you take the highest value item in the balance sheet. Normally the highest value item is the total assets or other side total liability plus total equity. Right? The balancing figure. You set that figure as 100. Either total assets. If the total assets is 100, the total liability and total equity figure also 100. And calculate a percentage of the individual item in the balance sheet. For example, if the total asset is 100, what is the total current assets figure? Right? You calculate a figure. Likewise, for all the items, you calculate a figure. Similarly, in the income statement also, you take the sales as the highest valued item. Stated that as 100. And based on that figure, calculate a percentage for individual items in the income statement as well. Thereby, you can identify the significant rupee and percentage changes and explain the changes. Right. We'll go to an example. If you go through this example, this is the figures of financial position ending 31st December 2016. And the figures of 2015 also given. Right. In this statement, 2016, we take total assets. There's a figure of 2,350. 2,350. We assume that it is 100. If the total asset 2,350 is 100, then what is the percentage that we can given for land? It will be 43%. What is the percentage that we can give for motor vehicle? It will be 21%. If your total asset 2,350 is 100, land 1,000 will become 43%. Motor vehicle 500 become 21%. Furniture 100 become 4%. Similarly, stocks, debtors, cash will be 11%, 15% and 6% respectively. Right. Similar comparison and calculation can be done for 2015 as well. Their total asset figure is 2,100. We will assume that as 100. If the 2100 is 100, then 750 land for 2015 will be 36%. Similarly, motor vehicle, furniture, 21%, 7%. Stocks, debtors, cash, 14, 12, and 10% respectively. Right. After doing so, what can we say? Now, if you take individual items, last year the fixed asset value is about 64% of the total assets. I add 36, 21, and 7 of the 2015 figures. Fixed assets, last year it will be it was 64% of the total assets. This year it is 68% of the total assets. 68% of the total assets. You take current assets, last year it was 36%, but this year it is 32%. 32%. Some part of current assets have been converted into the fixed asset category. Fixed assets have more dominance over the current assets, right? What is the benefit of having this vertical analysis? Now, this vertical analysis definitely benefit in one point where if the total two companies that we are comparing is in different size, right? If you take a small bank which has started their banking about 10 years back, their total asset figure is about 100 billion. And if you take a bigger bank, they have started their business more than 30 years or 50 years, and their balance sheet is 1 trillion, 1,000 billion. Now we are going to compare these two banks. It's very unreasonable if we take the horizontal figures, because the horizontal figures, the small banks may have, for example, say PAT 2019 and 2020, right? PAT 2019 and 2020. Last year, the small bank, they had a profit of 1 billion 2019. Now they have doubled their profit, or they have increased their profit to 1.5 billion. 29 PAT is 1 billion. 2020 PAT is 1.5 billion. Therefore, as a percentage, that is a 50% increase in profit. 50% increase in profit, right? Then the bigger bank, they may have last year recorded 10 billion, 2019. This year they have recorded only 13 billion. 13 billion. Therefore, we can say 30% increase in profit. Small bank, 50% increase in profit. Larger bank, 30% increase in profit. It is very unreasonable for the larger bank, if you compare, or the board of directors of the larger bank, if they compare, look at that smaller bank, their size also small, and they have increased 50%. But where in our case, we have only 30%. You have not done well compared to that smaller bank. That is an unreasonable statement. It's like comparing your PETA branch performance versus Aranaganwila branch. Right? Aranaganwila branch, your total asset side might be not even 500 million, not even 100 million. Not even 100 million. Maybe 200 million, right? But in here, PETA, your portfolio might be 10 billion, 50 billion, right? In that case, it's very unreasonable when you apply horizontal techniques to compare different size scale entities. Therefore, the best option is to use these vertical type of techniques where all the things will be expressed as percentages. As a percentage, what is the amount? If you go to the example that I have taken, the PAT and the sales, what is the percentage? If you take the Colombo branch and a rural area branch, what is the percentage? Similarly, if you take a large bank, compare it with the smaller bank, then you can use these vertical techniques to compare and contrast different size of business entities in the same industry. Any questions? If you do have questions, you can also send me a text message also, right?
Excuse me, sir.
Yes.
As you said, we have to analyze, do the vertical analysis for the same industry.
Same industry, or you can compare different industries, because it's all now. Normally, we do not compare different industries' financial statement for financial analysis. Now, like comparing a bank with the insurance company, comparing a manufacturer with the hospital industry person entity, that is not recommended. But for the sake of doing analysis, you can compare using the vertical analysis even in different industry also. But in the same industry, if you do have different size of entities where you can find material differences in between the figures, the horizontal analysis is not recommended. The best option is to compare it using the vertical analysis or either ratio. Right? Ratio we are yet to discuss. The best thing is to use the ratio analysis, but vertical analysis can also be accommodated, because that is give some understanding about the two different scale of business, but it is not comprehensive. We are only talk about the percentages. The best of the option is to do a ratio analysis for the two entities.
Thank you, sir.
But if you are in a different industries, don't compare and contrast, because industry to industry, the ratios, the figures, the financials, everything, the recognition, the accounting may be different. The formats, everything may be different. The technical jargons may be different. But you can compare, but when you are comparing, make sure that you compare only the vertical and the ratio aspects. But when you are trying to interpret the different types of industries, financial statements, make sure that you correctly interpret those findings as well. It's very rare chances you get to compare different types of industries. Only for now, if you take the award ceremonies, the overall categories, you have to compare. Other than that, even the award ceremonies, you have industry-wise awards. After that, when it comes to overall winning, you have to compare those industries, different industries as well. Right. Shall we go to the yes?
What are the occasion that we do the horizontal analysis? What are horizontal analysis is suitable for which situation?
Horizontal analysis you can do when you are writing a report about the own company, right? Now, it is a very given situation where uh, you compare the similar size companies and similar companies in the same industry, and when you write a report about the own company itself, normally when it comes to report writing, you have a combined effort of individual these three techniques, maybe horizontal part and maybe vertical part and the ratio analysis part. It will be a comparison and it will be a combined effort of the these three analytics, right? There is no such a situation where you only do the horizontal analysis, where you only do the vertical analysis, where you only do the ratio analysis. Horizontal analysis also play a vital roles when you write about the same company. It's very important when you compare previous year figures with the this year previous year budget, the budget against the actual. Those techniques also will come to light, also very essential. Horizontal, vertical and ratio combined analysis should be always provided when it comes to report writing. There is no particular situation where you can use the horizontal analysis, where you can use the vertical analysis. Always try to use the technique for the better explanation of the results. I think I have answered your question. Okay.
Thank you, sir.
Right. Then the main category of this particular model is devoted for the ratio analysis. Ratio analysis. Ratio analysis. I am going through these points. Normally, performance of a company is very relative in term, and ratios are indicators of performance. Then it shows the relative size of one financial statement component to another. We will see how it will, these points are being elaborated in the actual calculations. Last point also very important, effective only when used in comparison with the other ratios and other analysis and information. There is no conclusion where you can only use ratio analysis for a financial evaluation, right? It is very strongly recommend using the results of ratio analysis techniques, take other information into account, take other analysis into account, and finally conclude a point. Therefore, ratio analysis is very effective when you are using the results with other information and other techniques. Right. Normally, ratios are can be expressed in different form. Ratio is a measurement, and it is important to express a unit for the measurement. Some of the common units of expressing ratios are as follows. Normally, the most famous method is you express ratio as a percentage. Then some ratios, percentage, for example, gross profit ratio percentage, net profit ratio percentage, return on asset percentage, return on equity percentage. Then some ratios are expressed as a rupee term. For example, dividend per share, rupee term. Earning per share, rupee term, right? Then some ratios are expressed as a number, general number. For example, number, I do not have example right now in my mind, right? Some ratios you generally say a number. Then some ratios are number of times. For example, we can say yeah, interest number of times. What is this? Number of times asset turnover, right? Asset turnover number of times. Number of times you can take your turnover by using your assets, right? Then a fraction. Sometimes ratios are expressed as a fraction, not as a number. There can be some fractions also. As a proportion, the best example I can quote is the current ratio and the quick asset ratio. As a proportion, if you have current liability 1, what is your current asset portion? If you have a current liability 1, what is your quick asset amount? Right. Likewise, some are percentages, some are rupees, some are numbers, some are number of times, some are fractions, some are proportions. Right. This slide is the very important slide under ratio analysis. Right. Make a note of it. This is very, very important slide for ratio analysis. Right. Under ratio analysis, use of average balances. There are some situations where we have to use average balances. There are some situations where we do not require to use the average balances. Right? When I am correcting your papers, I tend to know that some have incorrectly used the average balances, where they could have used the same number, they average it and use it. But in a situation where you are required to use the average balances, some people, they just take the number and not the averages. They use that number for calculation. Therefore, I am explaining in this slide where to use the average balance and where not to use the average balances. Right. Ratios are computed based on figures identified from the financial statements, right? Normally we calculate and we take figures from the financial statements. Then point A. Some ratios are computed from figures only from the income statement, right? When it comes to ratio calculations, some ratios you take both figures from the income statement. Both figures from the income statement. If you are taking both figures from the income statement, there is no need to take any average balances. Under A, when the ratio is calculated from figures only from income statement, there is no need to take the average balances for those figures. Part B, some ratios are computed from the figures only from the statement of financial position. There also, if you calculate a ratio only taking from figures from balance sheet or the statement of financial position, you need not to take average balances. You need not to take average balances. Right? Then the critical situation comes where point number C. Now I explain point A, where you only take figures from income statement in order to calculate the ratio, where you need not to take any average balances. Then I explained point number B, where you take only figures from the balance sheet or the statement of financial position to calculate the ratio. There also you need not to take any average balances for that calculation. Then the one left is situation where you take one figure from the income statement and the other figure from the statement of financial position. One figure from the P&L and other figure from the balance sheet. Right. In that case, read the point number C. Some ratios are computed from the figures from income statement and statement of financial position. In that case, point number 1, income statement is for a given period. Income statement is for a given period, 12-month period normally. Usually 1 year. Financial position or statement of financial position is at a specific date. It is like a snapshot, right? When you take a snapshot or a photo, before that moment and after that moment, few seconds before that moment, few seconds after that moment, all the expressions will be different. Stance, facial expression, everything, body language, everything is different. Now, when you're taking a photo, at that time, your facial expression, your stance, your body language, everything will be get reflected at that moment only. Before that moment, few seconds. After that moment, few seconds. Your stance, everything will get different. Therefore, likewise, taking a photo, snapshot, balance sheet also, we are providing figures as at a particular date. Therefore, before that date and after that date, your balance sheet figures can be different. Right? That is the point. Number 1. When computing the ratio under C above for financial position data, use average balances. Therefore, when you are calculating a ratio, one from the income statement, one from the statement of financial position, in that case, make sure that you take the average figures from the balance sheet or statement financial position. How do you average? Take the beginning balance, take the end balance, take the total, divided it by 2 or into 0.5. Right? Under note, in the event of insufficient data for comparison, year-end figure may be used instead. If you are not given or if you are not given a chance to calculate the figures, two figures at the beginning or at the end, then in that case, you can use the year-end figure instead of taking the average figure. If you have given the figures, don't mess up with that thing. Under point C, if some ratio is calculated with the figures of income statement and the balance sheet figure should be an average one. Right. I hope this is very clear for all. If you have any questions, because this is when it comes to calculation in the exam, some people miss this point. This is very crucial. If it is only figures from income statement, no need to take averages. If the ratio is computed only figures from the balance sheet, no need to average. If some ratio is calculated based on one figure from the income statement and one figure from the balance sheet, the figure from the balance sheet should be an average one. Right? For you to calculate the average, the year beginning and the year end figure should be there. If you are not provided with the year beginning figure, you can take the year end figure as an average figure. I hope everyone is clear on this point. If you do have any question, please raise. I hope I have answered all the questions raised in the text box. If it is not, please let me know again. Right. Now this slide is very important to understand. If you incorrectly calculate the figures under ratio analysis, you will be losing lot of marks. Therefore, very important that you understand this and correctly record it in your mind, right, till the exam comes. Are we okay? Right. Okay. We'll go to the next slide. Right. ඔගලන්ට මොනාරි ප්‍රශ්න තියෙනවා නම් සිංහලෙන් හරි අහන්න හිතේ තියාගෙන ඉන්න එපා. right? විභාගෙට ගිහිල්ලා ඔගොල්ලෝ වැරදි දෙයක් කරොත් විභාගේ ෆේල් වෙනවා. එතකොට ආයෙසර එක තමයි ලියන්න වෙන්නේ. මෙතනදී ප්‍රශ්නයක් අහලා ඒක වැරදුනාට කමන්නේ. මොකද දැන් මේ කවුරුත් පේන්නේ නැහනේ. ඔයගොල්ලන්ට අවස්ථාව දෙන ඕන ප්‍රශ්නයක් අහන්න ඕනම ලැන්ග්වේජ් එකකින් මම කිව්වා මේ තමිල් වලින් ඇහුවත් කමන්නේ. තව කෙනෙක් මට ඒක කියනවා නම් මෙන්න මේකයි අහපු ප්‍රශ්නේ කියලා.
So can you explain ratio analysis use average balance again?
Okay. මම ඒක සිංහලෙනුත් කියන්නම්, right?
Okay sir, thank you.
ඔව් මෙන්න මේව තමයි පළවෙනි එක. අපි රේෂියෝ එකක් හදනවා නම් ඉන්කම් ස්ටේට්මන්ට් එකේ ඉන්කම් ස්ටේට්මන්ට් කියලා කියන්නේ P&L එක තියෙනවනේ. ඉන්කම් ස්ටේට්මන්ට් එකේ ෆිගර්ස් දෙකක් යූස් කරලා අපි රේෂියෝ එකක් හදනවා නම් ඒකෙදී අපි ඇවරේජ් බැලන්සස් ගන්න ඕනේ නැහැ. අපි ඒ රේෂියෝ එකට ගන්න ඉන්කම් ස්ටේට්මන්ට් එකේම ෆිගර්ස් දෙකක් නම්. ඊළඟට දෙවෙනි කැටගරි එකේ B එකේ කියන්නේ අපි රේෂියෝ එකක් හදනවා නම් ඒකෙදී අපි යූස් කරන්නේ බැලන්ස් ෂීට් එකේ තියෙන ෆිගර්ස් දෙක විතර නම් ෆිගර්ස් දෙකක් විතර නම් ඒකෙදිත් අපි ඇවරේජ් බැලන්ස් එකක් ගන්න ඕනේ නැහැ කිසිම ෆිගර් එකක. තුන්වෙනි සිටුේෂන් එකේ සිටුේෂන් C එකේදී තමයි අපි ඇවරේජ් බැලන්සස් ගන්න ඕනේ. ඒකෙදී අපි යූස් කරන්නේ එක ෆිගර් එකක් ඉන්කම් ස්ටේට්මන්ට් එකකින් අනිත් ෆිගර් එක අපි යූස් කරන්නේ බැලන්ස් ෂීට් එකකින්. එතකොට ඒ වගේ වෙලාවක බැලන්ස් ෂීට් එකකින් ගන්න ෆිගර් එක අනිවාර්යයෙන්ම අපි ඇවරේජ් ෆිගර් එකක් හැටියට ගන්න ඕනේ. දැන් උදාහරණයක් හැටියට මෙන්න මෙහෙම එකක්. අපි රේෂියෝ එකක් තියෙනවා return on equity කියලා. එතකොට return කියන එක අපි ගන්නෙ profit after tax. ඒක income statement එකේ figure එක. එතකොට ඒක අපි average එකක් ගන්න ඕනේ නෑ. හැබැයි equity කියන එක equity කියන්නේ balance sheet එකේ figure එක. එතකොට balance sheet එකේ figure එකක් ගන්නවා නම් අනිවාර්යයෙන්ම average balance එකක් ගන්න ඕනේ. එතකොට අපි බලන්න ඕනේ balance sheet එකට ගිහලා අවුරුද්දේ මුල equity එක කීයද? අවුරුද්දේ අග equity එක කීයද? ඒ දෙක එකතු කරා දෙකෙන් බෙදුවා average equity එක හොයාගත්තා. නිකන් හරි ඔගේ අර නෝට් එකේ දාලා තින්නේ අවුරුද්දේ මුල ඉක්විටි එක හොයාගන්න අපිට ගානේ තොරතුරු දීලා තිබ්බේ නැත්නම් අපි හිතනවා ඇවරේජ් ෆිගර් එක අවුරුද්දේ අග ඉක්විටි එක කියලා. මම හිතනවා දැන් ක්ලියර් කියලා හැමෝටම. දැන් මෙච්චරත් කියලා දීලා විභාගයට ගිහිල්ලා කොහොම හරි try කරලා පුළුවන් නම් ඇවරේජ් එක යූස් කරන්න ඕන තැනට ඇවරේජ් කරන්න නැතුව ගන්න පුළුවන් ඕලන්ට. right? right ඒකින්ද මේ පන්තියේදී මොන හරි ප්‍රශ්න තියෙනවා නම් අහන්න ඔයගොල්ලෝට ප්‍රශ්න තියෙන ඕන එකක් අහන්න. දැන් මේ මම පන්ති පටන් ගන්නකොටත් කිව්වා මේ අන්තිමට තිබ්බ එක්සෑම් එකේ මේ දැන් හිට අනිද්දාලා තව එකක් තියන්න තියෙනවා මාර්තු මාසේ ඊට කලින් තිබ්බ එක්සෑම් එකේ අපි ස්ට්‍රක්චර් එක වෙනස් කරා මේ මොඩල් දෙකක් තිබ්බා. කලින් තිබ්බ එක පේපර් එක උනාට දැන් මොඩල් දෙකක්. ඒතර මේ මොඩල් දෙකේ එකක් තමයි මේ සෙක්ෂන් එකෙන් එක සම්පූර්ණ ලකුණු ගාණක් එනවා. ඒතර මේ ලකුණු ගාන එන ගාන ඇවරේජ් එකක් ගන්න ඕනේ අනිත් සෙක්ෂන් එකේ මේ ෆයිනෑන්ෂල් ඇනලිසිස් එක ඇරුණාම අනිත් සෙක්ෂන් එකෙත් ඇවරේජ් ලකුණු ගානක් ඕනේ. ඔය දෙකේම ඇවරේජ් එක ඕනේ තමයි ඔයගලන්ට පාස් වෙන්නේ. ඒතර ගිය සැරේ තිබ්බ විභාගයෙන් සාමාන්‍යයෙන් ළමයි 80%ක් විතර පාස් වෙන එකේ ගිය සැරේ අන්තිමට තිබ්බ විභාගයෙන් 50%ක් විතර තමයි පාස් වෙලා තියෙන්නේ. ඒක නිසා මේක ගොඩාක් ඔලුවට අරගන්න ඔයගොල්ලන්ගේ ප්‍රශ්න තියෙන ගන්න ඔයගොල්ලන්ට විභාගයේ දිගට කරන්න ආසාවක් තියෙනවා නම් මෙහෙම ඔලුවට ගන්න ඕනේ නෑ. දැන් ඔයගොල්ලෝ හැමෝම ඉන්නේ මොකක් හරි පර්පස් එකකනේ මේ එක්සෑම් එකට රෙජිස්ටර් වෙලා තියෙන්නේ. ඒකින්ද ඒක ඔලුවට අරගෙන ඒක අනිවාර්යයෙන්ම හොඳට කරන්න. right okay any further questions? Right, we'll go to the next slide. If you take ratio analysis, what we did do under ratio analysis normally can be categorized into these categories, normally 6 categories. We calculate ratios under profitability. We calculate ratios under liquidity and solvency. We calculate ratios under working capital. We calculate ratios under gearing. We calculate ratios under asset utilization. And finally, we calculate ratios under shareholders or investors category. Right? If you take profitability, there are about 5-6 ratios. Similarly, under each category, there are about 2 to 5 to 6 ratios which we have to discuss. Right? Now, I am going to discuss those ratios under individual categories of these things. Right? First, we'll go to the profitability category. Right? These are the most famous ratios under profitability. There are about 5 to 6 ratios. First ratio is gross profit ratio. Gross profit ratio. Under gross profit ratio, we compare gross profit to sales. Gross profit to sales. Normally, we calculate this ratio, gross profit divided by sales into 100. Now, if I recall what we have discussed a moment ago, this ratio, gross profit and sales, both items are from the income statement. Are we need to take any average balances here? No. Because both items are from the income statement, where in that situation, no need to take any average balances. Right? Now, even if you take this ratio, is the very simple ratio to calculate. Now, for unfortunately, I can find only few number of students, not large, few number of students, say 1 or 2 or 3 people, they have still struggled to calculate this gross profit ratio. Even though this is very easy to calculate, they have failed to calculate even the gross profit ratio. How come I asked those people this exam? If you don't know how to calculate gross profit ratio, that is very embarrassing situation. But sometimes people, because of their hurriness, they incorrectly take figures, right? For gross profit, they will take different figure. For sale, they will take different figures and calculate. Make sure that you take the correct figure for this gross profit ratio calculation. Under the gross profit, the second ratio is net profit. Net profit ratio. Similar calculation to the gross profit. Net profit ratio also, we take the net profit after tax, right? Net profit after tax, divided it by sales into 100. Here also, net profit and the sales both are taken from the income statement. Therefore, no need to take any average balances. No need to take any average balances. Both are from income statement, no need to take any average balances. Right. Now, once you calculate the gross profit and the net profit ratio, how do you interpret? That is also very important. First you calculate, then you have to do an interpretation. Right? Normally, when it's come to gross profit, the gross profit cannot be vary from 1 year to another. From 1 year to another. It's very unique, identical normally to the industry. If you can find a material variations like increase in gross profit ratio or decrease in gross profit ratio, there should be some valid points for that thing. The most valid point can be either you have reduced materially your sales prices, or either your cost of goods or cost of things have increased, right? The purchase value have materially increased due to some reason, right? If there is no material variances in the purchases or the sales, then you cannot find a material or significant increase or decrease to the gross profit. It should be identical. It should be a similar ratio to the previous year. It should be similar ratio to the industry. Therefore, any material variance in the gross profit ratio, you should have, or you should find reasons for what this variation has occurred, whether it is increase or decrease. Then the second ratio, net profit ratio, under net profit, you can see variances. But with the I don't know, I don't want to say that net profit ratio should be identical like gross profit, but there can be variations, not identical ratios for the net profit. But if you do have expenses increased throughout the year, then your net profit ratio will get deteriorated. If you can manage, especially in 2020, most of the companies, they have curtailed their cost. Thereby, since they have not, now if you take banks, their income lines have been materially reduced due to various reasons. If you take loan growth, low loan growth is there. Then AWPLR materially reduced. Then since no loan growth, you have deposit where you have excess liquidity and you don't have any avenues to lend, right? Then on the other hand, you have this what is called moratorium, right? Where the customers have been given concession interest rate, like if you take some moratorium loans, we have to apply 7% for the moratorium period. And on the other hand, banks were instructed not to charge any additional charges for the customers, right? And other thing is to withhold all the these recovery actions against the non-performing loans, right? Ceasing and those things have to be stopped. Then if you take these check return charges and interest rates of some products like pawning, credit card, they have a cap introduced. Due to those things, the income lines got hammered 2020. Therefore, banks had to adapt to that situation, and there was some cost curtailment was there. And they have to stop all the unnecessary marketing expenses, unnecessary events, cutting of interest rates for deposits, right? And lot of now if you take a small in size example, like if you take this training arrangement, normally banks, normally normal size bank spend about 200 million for training. Now those costs will have to be cut. Most of the bank, they did their training using these online platforms. And electricity, and there were some benefits also because of the lockdown. The electricity, water, and other janitorial expenses have been reduced, but special attention was given by the every business entity in 2020 to curtail cost because of the drop in income lines, right? Therefore, you have to see in a given client financial statement whether net profit ratio is reduced or increased, and what are the reasons for the that said contributions, right? Said increase or said decrease, what were the main contributors for that thing? Then interest cover. This is also a profitability ratio. Here you take the profit before interest and taxes and express as a percentage or proportion, sorry, not the percentage, as a proportion of the interest payable. You take the interest and you take the net profit before tax and before interest. Before tax and before interest. Right? We'll take an example. You have an interest expense of 50. You have an interest expense of 50. And you have a profit before tax of 500. Interest expense is 50, profit before tax is 500. And you add interest also to the profit before tax, because when you calculate the profit before tax, you deduct the interest, right? And if you add the profit before tax, the interest portion, it will become 500, become 550. Then that amount you have to divide by interest. 550 divided by 50, then it will be 11 times. What is the meaning of this 11 times? It says this company can pay 11 times using their profits the interest. This company can pay 11 times using their profits the interest. That is how you interpret the interest cover. Higher the number, better it is. Higher the number, better it is. Higher the number, better it is. Up to now, any questions you can raise?
So please explain that interest cover.
Again, right, okay. Right, for example, say your interest expense is 50 rupees. And your profit before tax, say profit after tax is 450. You have a tax expense of 50, you add back that, then your profit before tax is 500. And 500 means you deduct that interest expense 50. Thereafter, you arrive at this 500 figure, because it is a profit before tax figure. Only tax has not been deducted. Then you add back your interest to arrive at the figure that you want, that is profit before interest and tax. Profit before interest and tax. Then it will be 550. 550. Then you divided it by interest expense. That is 50 rupees. No? 550 divided by 50. It will be 11 times. 11 times. It will be 11 times. If how do you explain this 11 times figure? Using your profit before tax and interest, you can pay 11 times your interest expense. You can pay 11 times your interest expense. There can be another company where this amount might be 5 times. There, that company can only pay 5 times using their profits the interest. But in this example, your company, they can pay 11 times of their interest using their profit. Therefore, higher the number, better it is. Higher the number, better it is. And we are not using any average figures, since we are using all figures from the income statement. Are we clear?
Yes, sir. Thank you.
Right, okay. Right. We are going to calculate at least 2 or 3 questions previously to get an understanding about how the calculation process is undergo, right? But this is I am only just explaining the things. Don't be afraid to ask any questions, but we will do definitely at least 3 sums for these individual ratios, right? Then return on equity. Return on equity. If you take the return on equity, that is return to our shareholders. Return to our shareholders, right? Here the return means shareholders are entitled only to net profit after tax. After everything, what is remain is the entitlement of the shareholders. Therefore, we have to take net profit after tax. That is the last item in the income statement before any distribution of dividend, right? Take the net profit after tax and it as a return to the equity investments or our shareholders investments, right? You take net profit after tax, divided it by average equity. Why we take the average equity? Because net profit after tax is an income statement item.
Sometimes line is not clear, sir.
Line is not clear. අනෙක් කට්ටියටත් එහෙමද? නැත්නම් සමහර වෙලාවට ඔය ඉන්ටර්නෙට් වල තියෙන ප්‍රශ්න හින්දා සමහර මේවට මේ වෙනවා. අනිත් කට්ටියටත් එහෙමද?
It's clear, sir.
Right, okay. Anyway, this will be recorded and will be put in the web in your IBSL. And if you have any unclear sentence or unclear discussions, you can go and visit and that you can again you can heard those things, right? Right, please unmute your sorry, mute your mics. නැත්නම් ගෙවල් වල කතා ඔක්කොම මේ ඇහෙනවා. Right, okay. In this ratio, we take average of equity. Why we take the average of equity? Because net profit after tax is a item that we take from the income statement, and the equity we have to take it from the balance sheet. When you have that category, that is income statement figure and the balance sheet figure, you have to take the balance sheet figure as an average figure. That's why net profit after tax to the average equity capital. Average equity capital. Here equity means always equity means stated capital plus all the reserves. Stated capital plus all the reserves. Therefore, you have to take the beginning equity and the end equity, take the total and divided it by 2 or into 0.5. Then you can take the average equity, right? Net profit after tax divided it by average equity into 100. This will be expressed as a percentage. Higher the percentage, better it is. Higher the percentage, better it is. If the beginning balances have not been given for the equity average calculation, you can take the end equity figure as the average figure. Right. Are we clear on this ratio? Return on equity? Okay. We'll go to the next ratio. Return on capital employed. In most of the cases, if I ask this ratio, at least 10 to 15% of the students have normally incorrectly calculate this ratio, return on capital employed. Here we take the total capital, right? Here we take the total capital, and the other item is net profit before tax and before interest. Net profit before tax and before interest, because we take the total capital here. In a company, your assets can be financed either in two ways. Either your owners have to pay, send the capital, or we have to ask for debt from the other borrowers, like banks and other financial institutes. Therefore, here we take the total capital. Total capital comprised of two capitals, that is equity capital plus debt capital. Equity capital means stated capital plus reserves. Debt capital means long-term capital. Short-term liabilities we are not considering here. We take only the long-term capital. Therefore, since one item from the income statement and the other item from the balance sheet, we have to take the balance sheet figure as an average one. Take the net profit before interest, before tax, divided it by total capital average. Total capital average. Total capital in the sense equity capital plus long-term capital, long-term debt capital, take the average, right? I am not going to explain how do you calculate the average figure, you know. And this is also expressed as a percentage. Higher the percentage, better it is. If the insufficient data is there for you to calculate the average figures, then you have to take the year-end figure as the average figure. Year-end figure as the average figure. Right. Right. We'll go to the next ratio. That is also famous ratio for the banking industry. Return on assets. Return on assets. Right. Here also the point is we take the return. It can be profit after tax or profit before tax. Normally people take profit after tax. It doesn't matter whether you take the profit before tax or after tax. Make sure the examiner's requirement. If the examiner requires you to calculate the return on asset after tax, take the profit after tax. If he requires to calculate the profit before tax figure, you take the profit before tax figure. Here also one item from the income statement, one item from the balance sheet. Take the average asset figure for the balance sheet figure. How do you calculate the average asset? Take the beginning total asset, take the year-end total asset, add it and divide it by 2. Right? Here one important point is, if you take normal business organization other than banks, the return on asset will become in the range of 20%, 30%, maybe higher than that. But when it's come to a bank, this return on asset figure will be very less than 2%. Very less than 2%. If the return on asset is 2%, that is a very good company. That is a very good company, right? Therefore, why it has come to that low, like 2%, 1% return, because banks are not doing well. No, not because of that. If you take banks' balance sheet, their asset size is huge. Normally, banks can attract deposits, thereby they do have huge balance sheets. If you take their balance sheet, asset side, largely comprised of loans and advances. And if you go to the liability and equity side, the composition is like liability 90%, mainly comprised of deposit, and only equity portion is only 10%. Whereas in other organization, normally equity portion is more than 50 to 60%. Only 40 to 30% is loan or other liabilities. But in case of other companies, they don't have luxury of attracting deposit. Banks only they have that luxury of attracting deposit. That's why their balance sheet is huge. Normally, a small size bank, they do have assets totaling up to 300 billion, 400 billion. Now, if you take big companies like JKH, SLT, Dialog, the very famous companies, their balance sheet size is not more than 300, 400 billion, right? But if you take a small size bank, their balance sheet is also more than 300, 400 billion. If you take these big banks, their balance sheet is nearing now 2 trillion, right? 2 trillion. 2 trillion means 2000 billions. Their balance sheets are huge. Banks' balance sheets are huge. And their return is compared to other organization, they do incorporate and they do action, they do operate in a business organization where interest rate is very sensitive and they have a net interest margin only, right? Whatever the gains from loans and advances, they have to pay back to the deposit holder, and margin will only be left with them. Therefore, the return is not that much higher compared to asset. They do have 1 trillion asset, but whereas they do only have about 10 to 20 billion profit. Therefore, their ROA may become 1% or 2%. Right? That's why banks do have very low ROA compared to other companies. But in your case, when you are doing credit analysis, you are not doing credit analysis for banks, no. You are doing credit analysis for other entities where they should have at least 10 to 15% ROA against the total assets. Right. Here also, if not sufficient data is available, you can use the year-end figures as average balances. Right. Under profitability ratio, any questions? Up to now, we have discussed about 5 to 6 ratios under profitability. Any questions? මොනාරි ප්‍රශ්න තියෙනවා නම් අහන්න. Right. දැන් මෙතන ඔයගොල්ලෝ ෆිසිකලි ආවනම් මම හැමෝගෙම ප්‍රශ්න අහනවා. මට දැන් පේන්නේ තියෙනද කාගේවත් මට එහෙම ප්‍රශ්න අහන්න බෑ. Right. For today's, I will stop at this up to this point. Now there was a question raised by one person. Moment. Under interest cover ratio, whether we are considering other import charges, financial fee. No, we only take the interest expense. We only take the interest expense, not other fees and charges, in order to calculate the interest cover ratio. Right. Okay, then next time also we'll come at 7 a.m. Next week. If you do have questions, you can text me into the text box, or otherwise we'll meet next week at 7 a.m. We will start from the liquidity ratio. Right? Okay.
Thank you, sir.
Okay. Thank you.
Thank you, sir.